Ann Sonders, Chief Investment Strategist at Charles Schwab. Ann, thanks so much for joining us. Great to see you as always. I mean, there's quite a few reasons out there for why we're selling off. Which stand out most of all for you?
Well, I think there are more catalysts than causes, and maybe that's just an exercise in semantics. But I think one of the underlying problems that established this situation where a catalyst, be it the resurgence in cases, concerns about lack of a stimulus package being passed pre-election, is that much like we saw in the beginning of September, as the market was doing well, like recently, it was accompanied by really rampant signs of speculation, not across the spectrum of sentiment indicators, but certainly by the cohort of what I've been calling newly minted day traders. You were seeing that speculative fervor in the options market, and in many cases trading without regard to underlying fundamentals. And that sentiment environment, when it gets stretched, sets up the possibility that you get a catalyst that causes a reversal in some of those recent trends. And as you suggested, Wolf, we had plenty of recent catalysts to kind of trigger this reversal that we're seeing.
Ann, how much of this do you think is the fact that the election is next week, and linked to that is the question mark over when we do see stimulus? And I guess I'm asking, how quickly could things turn around all of a sudden within the space of a week?
Well, I think part of it that might be election related is the fact that, and it's somewhat normal as you get closer to the actual election days, that some of the polls have narrowed a bit, particularly in some of the states that have been seen as sort of must wins for Trump. And I think in an environment where the polls were more decisively in favor of a Biden win, the related assumption there was that we would have less chance of a contested election, and in turn a greater chance that priority number one would be a stimulus package. I think now coming into the narrative, in the event we are looking at a much closer election, is an increased likelihood of a contested election. I think that was clearly a volatility driver back in early September. And the fact that with that uncertainty, both maybe at the presidential level and the congressional level, then you start to push out the timing for a fiscal relief package beyond what I think the market is comfortable with.
If you look at some of the hardest hit names, Ann, most names are down today. But if you look at where the pain is, it's actually in technology. A lot of the so-called stay-at-home winners, Zoom is down, Apple, Microsoft, all these names that had worked for so long on the idea that we were going to be staying at home. If it really is about rising cases, why aren't those names working on a day like today? Do you think their multiples are just too high? Is there no more opportunity there?
Well, the speculative fervor that I was talking about that you've seen by this particular cohort wasn't just in the options market, but even in the options market and the individual stock names. It was in those concentrated names, not just the big five that we often talk about that recently hit almost their own quartile in the S&P, but those highly popular names. And I think right now there's just a sell where profits have been. It's not really an adjustment of the narrative back to stay-at-home stocks. I think it's rethinking what's going to happen to the economy, even absent any kind of mandated shutdowns, the impact without a stimulus package that human beings and small businesses simply make decisions by virtue of the virus. That's a constraint on economic activity. I think we're starting to realize that you don't need mandated shutdowns to see a significant impact on the economy simply because of the uncertainty and fear factor.
US and what messages are you taking from the moves we've seen there for the equity market?
You know, it's been relatively quiet. You haven't seen the kind of maybe spike in yields that you might expect to see, or a plunge in yields if it was making an assessment on the overall economy longer term. So I think this is more about a pullback phase, a corrective phase that might have been more necessary in the equity market that doesn't necessarily need to translate into a similar amount of volatility on the fixed income side. So I think the shorter term story driving the relatively less activity in the fixed income side and much more activity and volatility on the equity side, I think is just a bit different.
Shepard Smith here. Thanks for watching CNBC on YouTube.